Hello students and welcome to Finance for Engineers course. Students, in earlier unit, the discussion has been made on long-term financing sources through which business firms can raise funds for long-term requirements. Today, we will start unit number 6, financing decisions and cost of capital. In this unit, we will make discussion on various important aspects like understanding what is risk and return, then knowing the concept of cost of various sources of long-term capital like equity capital, preference capital, debentures, etc. Now let us start with knowing what is risk and return. See, in financial management, a risk and return analysis determines how much risk is involved in investment related to its potential rate of return. So, the relationship between risk and return is fundamental investment concept. The concept that states an increased probability for return is highly correlated with the increase in the level of risk taken. The return normally is expressed as a percentage and it refers to the gains or losses made from an investment, whereas the risk element is associated with the volatility of that particular return. In theory, an investor could expect higher return on investment only if willing to accept a higher level of risk. Thus, we can say increased potential returns on investment usually go hand in hand with increased risk. Thus, return refers to either gains or losses made from the trading of a security. The return on an investment is expressed as a percentage, or it can be considered a random variable that takes any value within a given range. Several factors influence normally on the type of return that investors can expect from trading in the markets. After investing money in a project, a firm wants to get some outcomes from the project. The outcomes or the benefits that the investment generates are also called as returns. So let us see the concept of risk. A person making an investment always expects to get something in return from that investment in a future. However, as future is uncertain, the future expected returns too are uncertain. It is the uncertainty associated with the returns from an investment that introduces a risk into a project. The expected return is the uncertain future return that a firm expects normally to get from its project. Thus, the realized return, on the contrary, is the certain return that a firm has actually earned. Therefore, it can be said that a financial decision involves risk. So, for understanding this, let us see an example. A company that borrows money faces the risk that interest rate may change. That means it may increase or it may decrease. Also, a company that builds a new factory faces the risk that product sales may be lower than the expectations. The same can be in case of individual, that is the investors who buy financial securities, who invest their money in share market faces risk. What type of risk normally they faces? They, as they don't know what certainty the future selling price of their securities. That is nothing but market price of their shares, or they cannot say that how much cash inflow they will receive in a meantime. That means it can be a dividend, how much dividend they can earn from that particular investment. So this is nothing but a investment risk. So risk is everywhere. Whenever one person or a company think of investing money or think of taking any financial decision, it always involves risk. Uh, Let us see various risks involved in financial securities. So first here is industrial, commercial and labor risk. There are so many types of risk in this particular category. It includes lack of competitiveness, or it can be concerned with emergence of new competitors in the market, concerned with our industry, or an inadequate selling network, or strikes, etc. So this is one type of risk involved. Second is liquidity risk. This is the risk of not being able to sell a security at its fair value in a market as a result either of a liquidity discount, that is selling at a lower price, or the complete absence of a market or buyer. That means there is no buyer, there is no person showing interest in buying the securities or shares of a particular company. So this is called as a liquidity risk. Next, solvency risk. This is the risk that a creditor will lose his entire investment if a debtor cannot repay him in full. That means, who is a creditor? Creditor is a person who has supplied money or material to the company. And who is a debtor? Debtor is a buyer who has purchased material on credit basis or who has borrowed money from a creditor. So here, solvency risk is concerned with creditor who is unable to take money from the debtor. Okay, even if the debtor's assets are liquidated. That means debtor don't have that much money with himself to pay back whatever debt he has taken from a creditor. Traders also called this type of risk as a counterparty risk. Next type of risk is currency risk. See, fluctuations in exchange rate can lead to a loss of value of assets that are denominated in foreign currency. Similarly, higher exchange rates can increase the value of debt denominated in foreign currencies when it gets translated or converted into the company's reporting currency base, that is their home currency. When they convert it into home currency, the value may get reduced. It is one of the important risk involved in financial securities we can see. Next is interest rate risk. The holder of financial securities is exposed to the risk of interest rate fluctuations, even if the issuer fulfills his commitment entirely, there is still the risk of a capital loss or, at the very least, an opportunity loss. Next is political risk. This includes risk created by a particular political situations or decisions by political authorities. And the example for that can be nationalization without sufficient compensation, revolution, exclusion from certain markets, discriminatory tax policies, etc. So these are certain points which helps us to understand about the political risk. Now the next point is regulatory risk. A change in any law or in the regulations can directly affect the returns that are expected in particular sector. And here, pharmaceutical or banks, insurance companies are always in a front line for such regulatory risk. Next point is inflation risk. This is the risk that the investor will recover his investment with a depreciated currency. That is, that he will receive a return below the inflation rate. Next is the risk of fraud. This is the risk that some parties to an investment will lie or cheat, that is, by exploiting asymmetries of information in order to gain unfair advantage over other investors. And the example here, most common example is insider trading, normally happens in securities market. Now the next point is natural disaster risk, which we cannot avoid. It includes storms, earthquakes, volcanic eruptions, cyclones, tidal waves, etc., that destroys the assets of the company. Next is economic risk. This type of risk is characterized by a bull or bear market. Bull and bear market is very significant and it affects on the share prices or the prices of securities of the company. Next is anticipation of acceleration or slowdown in business activity or changes in the labor productivity. So these are the various risks involved in financial securities. Now let us see risk return trade-off. So what is this risk return trade-off? You can see here higher risk is associated with greater probability of higher return and lower risk with a greater probability of smaller return. That means we can say that there is a direct relationship between risk and return. High risk, high return, low risk, low return. So this particular trade-off which an investor faces between risk and return while considering investment decisions, this is called as a risk return trade-off. So now we will see next point, that is cost of capital, which is very significant while studying the financing decision of the organization. What is this cost of capital? It is the rate of return the firm expects to earn from its investment in order to increase the value of the firm in the marketplace. In other words, it is the rate of return that the suppliers of the capital requires as compensation for their contribution of capital. So who are the suppliers of capital? It can be equity shareholder, preference shareholder, debenture holder, or the bank or financial institutions. These are the people, these are the investors who are supplying their money to the organization and they expect some compensation for their contribution of capital. So, therefore, the cost of capital is nothing but an integral part of investment decision as it is used to measure the worth of investment proposal. It is used as a discount rate in determining the present value of future cash flows associated with capital projects. Conceptually, it is the minimum rate of return that a firm must earn on its investment so as to leave market price of its shares unchanged. It is also referred as cutoff rate, target rate, hurdle rate, required rate of return, and so on. Thus, cost of capital refers to the rate of return a firm must earn on its investment projects to increase the market value of its common shares, that is, equity shares, required by market suppliers of capital to attract funds to the firm. Thus, if project rate of return is more than the cost of capital, value of the firm increases, and if the project rate of return is less than the cost of capital, value of the firm decreases. And here, the ultimate goal is always to minimize cost of capital. You must have understood that the cost of capital is very important aspect one should understand, one should know, and it is a required rate of return that a firm must achieve in order to cover the cost of generating funds in the marketplace. See, based on their evaluation of riskiness of each firm, investors will supply new funds to a firm only if it pays them the required rate of return to compensate them for taking the risk of investing in the firm's bonds and stock. If indeed the cost of capital is the required rate of return that the firm must pay to generate funds, it becomes a guideline for measuring the profitabilities of different investments. When there are differences in the degree of risk between the firm and its divisions, a risk adjusted discount rate approach should be used to determine their profitability. So, students, you must have understood that capital is a necessary factor of production, and like any other factor, it also has a cost. In the case of debt capital, the cost is the interest rate that the firm must pay in order to borrow funds. For equity capital, the cost is the returns that must be paid to investors in the form of dividend and capital gains. Thus, the cost of capital is the rate of return that the enterprise must pay to satisfy providers of funds. The cost of equity is the return that ordinary stockholders expect to receive from their investment. The cost of loan stock is the rate which the company must provide its lenders. The weighted average cost of capital, firm's capital structure, is the average of the cost of its equity, preferred stocks, and loan stocks. An ideal mix of debt, preference shares, and equity can maximize the share prices. Debt capital is regarded as cheap source of finance to the business, but it will also increase the financial risk of the company. While common stock, that is, equity shares, are regarded as less risky, but might lead to loss of voting rights if bought by outsiders. Each type of funds the firm uses has a cost, and that the required rate of return for the firm is the weighted average of the cost of the individual components of the capital, that is, debt, preferred stock, and common equity, which is designated the weighted average cost of capital. Now, let us see factors affecting the cost of capital. The cost of capital is the minimum expected rate of return of the investors or suppliers of the funds to the firm. This we have understood. Now we'll see certain factors that affect on the cost of capital of the firm. Under that, first is risk-free interest rate. Risk-free interest rate is the interest rate on the risk-free and default-free securities. It depends upon the supply and demand consideration in financial market for long-term funds. The real interest rate, the purchasing power risk premium, is added normally to find out the risk-free interest rate. Second is business risk. The business risk is related to the response of the firm's earnings before interest and tax to the changes in sales revenue. See, every project has its effect on the business risk of the firm. If a firm accepts a proposal which is more risky than average present risk, the investor will probably raise the cost of funds so as to be compensated for the increased risk. Next is financial risk. The particular composition and mixing of different sources of finance is known as the financial plan or the capital structure, and it can affect the return available to the investors. That is, higher the proportion of fixed cost securities in the overall capital structure, greater would be the financial risk. And finally, next is other considerations. That means liquidity or marketability of the investment also can affect on the cost of capital. Higher the liquidity available with an investment, lower would be the premium demanded by the investor. Now, the next is cost of debt. What is this cost of debt? The cost of debt is the effective rate that a company pays on its current debt. The cost of debt is the return that a firm or company provides to its debt holders and creditors. These capital providers needs to be compensated for any risk exposure that comes with lending to a company. Not only does the cost of debt reflect the default risk of a company, it also reflects the level of interest rates in the market. This interest, whatever is paid to the debenture holders or to the debt, qualifies for tax deduction while determining the tax liability. And this is the formula used for calculating cost of debt. Cost of debt is equal to interest expense into bracket 1 minus tax rate. The cost of debt is generally the lowest among all sources, partly because the risk involved is low, but mainly because interest paid on debt is tax deductible. So, students, I'm ending this session here where we have discussed about cost of capital and tried to understand the risk and return trade-off, the relation that exists between risk and return. And in next lecture, we will continue with cost of debt. We'll see an example of cost of debt. Also, we will try to understand the debt as a cheaper form of finance. Then we'll continue with the cost of preferred capital, equity capital, etc. Thank you.